Hi everyone. In this video, we're going to try and talk about ratio analysis and build a step-by-step guide to create an Excel file with a company's numbers and calculate all the major ratios on it. Also take the next step of trying and identifying trends in those ratios and understanding what might be moving certain set of ratios and how do we find more information while analyzing those numbers, right? तो एक स्टेप बाय स्टेप गाइड बनाएंगे, एक कंपनी पिक करेंगे. वी विल लुक एट द एग्जांपल ऑफ स्टील अथॉरिटी ऑफ इंडिया लिमिटेड, सेल, स्टील कंपनी इन इंडिया. इसका डेटा पिक करेंगे, कंसोलिडेटेड एनुअल रिपोर्ट से डेटा हमने लिया है, उसको एक एक्सेल में फीड किया हुआ है. वी विल कैलकुलेट रेशियोज ऑन दैट एंड देन इंटरप्रेट दोज रेशियोज एज वी गो अलोंग इन दिस एंटायर एक्सरसाइज. The whole idea would be to pick data from annual reports. When you're starting out building a career in finance or trying to kind of learn financial analysis or ratio analysis, it is always a good idea to pick data from the annual reports in terms of as reported data. Two benefits out of it. One, when you pick data manually from annual reports and put it in the Excel file, you tend to notice large numbers a little bit better. कोई नंबर बहुत बड़ा है तो आप इमीडिएटली नोटिस करेंगे उस नंबर को, राइट? कि डेट इतना ज्यादा क्यों है या इन्वेंट्री इतनी ज्यादा क्यों है इन एनी काइंड ऑफ अ कंपनी, राइट? And the second benefit is that a lot of these websites which kind of give you this data, sometimes they make certain adjustments, all well valid and relevant adjustments. But initially in your career, what you want to do is look at as reported data. And if any adjustments are to be made, you do them yourselves. As you become more sort of at ease with ratio analysis, then you can go to these websites and pick data directly and try and understand that data, right? So Steel Authority of India का data pick करेंगे and bunch of ratios calculate करेंगे. First part of our discussion is going to be what these ratios are, कौन से ratios हैं, उनका क्या formula है, क्या understanding है, क्या interpretation है, how do we interpret them, what's the idea behind a particular ratio and what is the formula that we're using for that. And then we go about calculating all of it in the Excel file. Right. So some of the commonly used ratios would be on, we'll segregate them into various categories like profitability ratios. Profitability ratios will tell us how profitable a business is. For every 100 rupees of sales, what is the operating profit that you've generated or what is the net profit you've generated, right? So you can use operating profit margin, you can use net profit margin, EBITDA margin, EBIT margin, net profit margin. All of these are typically a part of the profitability ratios. The second chunk of ratios that we look at is return ratios. Right? Now, profitability ratios are higher, the better, right? Similarly, return ratios are generally higher, the better. But sometimes what happens is too high a number may be giving a slightly misleading picture about a particular company, right? But we'll dig deeper into that as we go along. Return on equity or return on capital employed are the two most common ratios that we use here. Return on equity is nothing but shareholders have given you the money in the form of equity. What is the money you're generating on that? कितना नेट प्रॉफिट आपने शेयर होल्डर के फंड्स पे जनरेट किया है, दैट इज व्हाट इज द रिटर्न ऑन इक्विटी. Return on capital employed, on the other hand, looks at all kinds of money that you have taken. So both from equity holders and from debt holders, whatever money you have taken, you basically take that in the denominator. And in the numerator, you use this metric called earnings before interest and tax. क्यों कर रहे हैं? Why are we doing that? Is because, in the denominator, you have both equity and debt holders kind of shown. So in the numerator, you want to use a metric of earnings that is allocated to both equity and debt holders. So EBIT includes the interest component and hence we typically use EBIT. This principle is called the principle of consistency so that both the numerator and denominator apply to the same set of stakeholders, right? That's a couple of return ratios that we typically calculate. Idea is to look at, is the company really generating enough amount of returns for its shareholders? Generally, higher return ratios denote access to capital. अगर एक कंपनी का रिटर्न ऑन इक्विटी कम है तो जनरली शेयर होल्डर्स ऐसा कहेंगे कि प्लीज रिटर्न आवर मनी टू अस, वी डोंट वांट टू काइंड ऑफ रीइन्वेस्ट इट इन द बिजनेस, गिव इट टू अस एज डिविडेंड, वील रीइन्वेस्ट इट एल्सवेयर, राइट? Whereas if return on equity or return on capital employed are higher, then typically what is going to happen is company will always have access to capital, right? So those are return ratios that we're going to look at. Then stability ratios in terms of leverage, debt to equity, typically total debt divided by equity of the company. Generally, some textbooks also tell you to use long-term debt upon equity. You can use either, that's okay. I'm not a very big stickler for definitions. As long as आप एक ratio का definition use कर रहे हैं जो logical है, use it consistently across all your calculations, all your comparisons, that is fine. You don't have to go specifically by the textbook in a lot of these. You can create multiple sort of definitions for the same ratio and see how that pans out. That's okay, right? I prefer using both long-term and short-term debt because sometimes, companies tend to use these interchangeably in terms of their operations, and you just want to look at what is the total interest-bearing debt that the company has, right? Another ratio in this line is something called as a coverage ratio, is how much does your profit before interest covers your interest by. That's called the interest coverage ratio, calculated as EBIT by interest. I think this is a more important metric from our understanding of the credit worthiness of a company. How easily can it repay its debt? ये हमें coverage ratio से idea लगेगा. And then there is a bunch of ratios around efficiency of the company, which is all turnover ratios. Now, here some divergence is seen in terms of what is being explained in a lot of textbooks about some of these ratios in terms of the formula that is used and what is commonly used in the industry, specifically in the equity analysis side of things. So, for example, generally, to understand this a little bit better, all turnover ratios talk a bit about efficiency. And because it is talking a bit about efficiency, it's going to kind of compare some asset typically with the sales you've made, right? So how much sales have you made using a certain amount of fixed assets is basically going to tell you the fixed asset turnover ratio, for example, right? Now, I have used sales everywhere. So inventory turnover is sales upon inventory, receivable turnover is sales upon receivables. Textbooks obviously give a slightly different definition of inventory turnover, which is COGS upon inventory. You can use that as well. But generally in the industry around equity valuation or equity analysis or fund management, people tend to use sales. One, because it is easy to compare across firms. Two, because technically standing outside the company, you don't even have an exact understanding of the COGS, right? हम raw material cost को COGS मान लेंगे. We will assume raw material cost to be COGS. But that may not give you a very complete picture of the exact cost of goods sold, which should include all directly attributable costs as well, right? And generally, from a comparative perspective, because sales includes the margin you have created over and above your cost, sometimes it is a better indicator when you're comparing companies, right? So if it is in isolation, you can use COGS, but while comparing, using sales makes it a little bit more standardized calculation. So we'll use sales everywhere. So all turnover ratios are basically sales upon a particular metric. How much is your sales? How many times is your sales compared to that metric? Higher the number, more efficient you are. With a smaller use of asset like an inventory or a receivable or a fixed asset, you're able to generate higher amount of sales. That is what turnover ratios are basically telling us, right? So this is a bunch of ratios. Obviously, there can be more. There is current ratio, which is there, which is typically more relevant from the credit profiling perspective of a company. If you're an equity analyst, it may not necessarily be your key metric, but we can calculate that as well. There are growth metrics that are there. There can be business metrics that are there. For example, you could find out what is the revenue per ton of steel production in the case of Steel Authority of India. You could calculate EBITDA per ton. So we can look at some of those examples as we kind of go along and understand that. To put this in perspective, let's quickly go to our Excel file now, where we have the data for Steel Authority of India and its numbers for the last few years put in. We already have data for balance sheet and P&L, and we will try and calculate ratios on that. All these numbers are in INR crore. For the last 7-8 years, we have punched that in. So we'll go to this ratio sheet. And what we're going to do is we're going to calculate ratios 2018 onwards. So a few years pre the pandemic and a few years post the pandemic. And I'm going to segregate all the numbers and put the ratio formula there as well. Once again, you're free to use different formula. That's your choice. I don't have a problem with that, as long as you're using it consistently as you're going along, and as long as there's a logical basis for that formula being used there, right? So we'll start with profitability ratios, right? And let's embolden it, and we'll look at operating margin. We will look at EBIT margin. We will look at net profit margin, right? Now, when I say operating margin, a lot of global textbooks assume EBIT to be operating profit. So if you're using international textbooks and reading about it, typically EBIT upon net sales or sales operating revenue is what is considered as operating margin. But in India, most companies report it as EBITDA upon sales. Wherever I'm saying sales here, this is going to be net revenue from operations in our discussions, right? Now, EBITDA, operating profit and EBIT margin typically should be excluding other income as far as possible. You would want to kind of remove other income out of this discussion because other income is just incidental to the business. In net profit, because it's post-tax and other income may also be taxed, typically you get the entire part. So here you will use the entire sales. Whereas in the context of EBITDA and all, I will probably choose just operating revenue or revenue from operations is what I'm going to choose, right? Once again, there is no rule that you have to choose this. You can choose whatever you want to, and that's absolutely fine as well, right? So let's quickly go to 2018. First, what happens on the P&L is you will get profit before exceptional item, share of net profits and all of that. You don't necessarily get the EBITDA number. So now if you look at this carefully, you have revenue from operations, which is available with us. And I have all the costs which are available, but the costs include finance cost and depreciation expense. So I have to add that back. So my EBITDA, for example, is going to be my revenue from operations in that year minus all my expenses plus, remember the expenses already include depreciation. So I have to add back depreciation. I have to add back finance cost. That gives me my EBITDA, right? So this is what I will get. Effectively, this is sales revenue from operations minus total expenses plus finance cost plus depreciation and amortization expense. So that gives me EBITDA. From this number, if I just remove the depreciation, if I just remove the depreciation and amortization, I should get EBIT. Correct? So this is what we have calculated. EBITDA and EBIT have been calculated. Let's quickly calculate the ratios. So EBITDA upon, we'll start 2018 onwards because the first column we've used for formula. So we'll just start 2018 onwards. That's okay. Divided by revenue from operations. Similarly, EBIT will be, go to the P&L and look at EBIT as a number for 2018, 1570 divided by revenue from operations. Right, so both of these are calculated, and net profit on the P&L will be basically my final profit for the year, which is 281 negative, divided by total income, total sales, because this now includes the other income as well. So here I will use both of them. Let's just quickly format all of this together. These are all sort of exhibited in the form of percentages, and I can drag all of this till 2024 to get all my information from 18 to 24. Correct? That's profitability metrics. We will come back and talk about it. For now, let's keep it here. The second set of metrics would be return ratios. So we will calculate ROE, return on equity. Let's write all of that. Return on equity, sorry. And we will calculate return on capital employed. And the formula for return on equity will be net profit divided by equity. And the formula for this would be EBIT divided by equity plus debt. Now remember, equity for this company is going to include both share capital and reserves and surplus, right? So when I divide for 2018, just be careful you're using 2018 because we're not really using 2017 data. So profit for the year divided by, on the balance sheet, let's just look at where is the equity data. This total number of equity, total equity is equity data, right? So I'm going to use this. And here I'm going to use EBIT. Where is EBIT? That's here, 1570 for 2018 divided by, bracket open, I will add total equity plus non-current borrowings plus current borrowings. So I'll include all of this, right? And then close bracket, enter. So this is my return ratios. I have calculated both of them. I can put a percentage around that and drag it on the right side. All the return ratios have also been calculated, correct? So this is done. Now, there are some nuances to this. I will talk about them as we go along in terms of what changes may be needed to be done in some of these formula of late. Let's calculate debt ratios, and I'll calculate both debt upon equity and interest coverage ratio here. So this will be total debt upon equity is what we will look at, and this will be EBIT upon interest or finance cost. So total debt upon equity in brackets for 2018 will be the sum of long-term borrowings plus short-term borrowings divided by my equity, total equity number. This you can also use market cap, by the way, but because we are using financial statements, we will basically stick to that. And EBIT upon interest on the P&L will be my EBIT, 2018 EBIT divided by the finance cost for that year, which is this number. So EBIT doesn't cover finance cost for sale in that particular year. I'll just use one decimal, that'll be easier, and drag it on the right side. So that's all my debt ratios that we have calculated. And then we can go to sort of efficiency ratios or turnover ratios that we are looking at. Control B, and we'll look at a bunch of these. Let's look at fixed asset turnover. We will look at inventory turnover. We will look at receivable turnover. And I'm going to just use sales upon fixed assets, sales upon inventory, sales upon receivables. We can also then convert it into days sales outstanding notation, right? Remember, we see that in terms of days. So 365 divided by a turnover ratio gives that. So we'll get a sense of working capital as well. So in fact, we will also calculate payable turnover ratio here, which will be sales upon payables. So let's do that. Sorry. And let's calculate that, right? So 2018, my sales is operations, revenue from operations only, right? So revenue from operations divided by my fixed assets. So my fixed assets on the balance sheet would be a bunch of things put together. That's plant property plus capital work in progress plus right of use assets plus intangible assets. Right? These are typically your fixed assets that we are going to use. So I'm going to use all of that. Right? This is sales upon inventory. Now, in this particular case, interestingly, what they classify, some of the inventory is actually long-term inventory. We'll see that. So P&L, go to sales divided by, when you look at inventory on the balance sheet, you'll see inventory, long-term inventory as well. So let's see, here it is. This is non-current inventory. It's zero in this year, but post 2020, they've started classifying some of that there. And short-term inventory is here. So I'm going to add both of them together to get a complete picture of what is the inventory. Sales upon receivables. Let's look. I think receivables also, if I'm not wrong, they give long-term receivables as well and short-term receivables as well. So we'll combine that as we go along, right? So let's look at trade receivables in that context in terms of what is long-term receivable and what is short-term receivable, and try and decode that. And let's calculate that quickly here as well. So that's going to be revenue from operations on the P&L here divided by, on the balance sheet, I will look at receivables for 2018 plus trade receivables, short-term current assets, which are there. Sometimes businesses can have longer term, more than 1 year kind of receivable or more than 1 year kind of inventory that they've held up. So that's there. And similarly, payable turnover will be basically my revenue, which is here, divided by my payables. So on the payables side, on the liabilities side, let's look at, there's actually long-term payables as well. So I'm going to actually put a bracket here and add long-term payables as well. It's a good exercise that we've looked at here because it is giving us an insight into companies that have long-term payables and long-term receivables as well. Once again, we will format all of this to a single decimal point. So it becomes easier for us to sort of look at and comprehend, and then drag it on the right side. Right. So that gives us a sense of the ratios that we have calculated. I would also actually want to calculate the growth rates, right? So maybe what we can do is growth ratios, and I can do that in sales or revenue from operations. So annual growth rate this year minus last year by last year. So we're going to calculate that, or you can just do this year divided by last year minus 1. So I'm going to look at 2018 revenue from operations divided by last year minus 1. That's the growth rate in sales. And let's say we want to do this for EBITDA, right? And I'm going to calculate EBITDA growth rates for 2018. That's going to be this year EBITDA divided by last year EBITDA minus 1. So we get these numbers. Once again, these are percentages, remember, so I'll have to put percentages and then drag it on the right side. Obviously, EBITDA growth percentages the first year looks a random number because it's grown from a very small number and kind of moved ahead. I can separately calculate what is called as CAGR, right? Compounded annualized growth rate. Let's say I want to do that between 2024 and 2018, right? So 18 to 19 is 1 year, 22, 21, 22, 23, and 24. So 6 years is what we are looking at. So if I have to, let's say, calculate CAGR here, then what I'm going to do is this year sales divided by 2018 sales raised to the power 1 by 6 minus 1. That's how we will calculate the CAGR. So there's a 10% CAGR that we see here. And I can basically just copy this formula for EBITDA as well, or profits as well. Some of these will give you, odd kind of numbers, or may give you odd kind of numbers, especially if there are losses anywhere. So that's how you calculate for CAGRs, right? Now, this is an initial first cut quick calculation of all the ratios. Now let's try and understand the analysis of this, or just understand where is this coming from and how do you go and interpret some of these numbers, right? So now you see that 2018 was not such a great year, obviously, because margins were very low. Margins started going up, peaked around 2022, right? So now when you're analyzing this, right, and this video may not be able to analyze everything, but at least it gives you the questions to research a little bit more, which is what happened in 2022? Why are margins higher? Right? Why are margins higher? Seems like profitability has jumped up a lot. So what has caused that, right? And now we can go down and also try and see, you see revenue from operations spiked up significantly. So we can now go and check, was it because of your prices going up in terms of steel prices, or was it because production went up? So one of those two things, or a combination of both of them, should kind of apply. If you dig a little bit deeper, you will find steel prices went up a lot during 2022. Post-corona, China had some supply shutdown, and because of that, steel prices went up globally, and a lot of these companies made a lot of profit around that period, right? So that is one. Obviously, your return ratios also improve around that period. But historically, other than that, it's not a very high return ratio business. It's a low ROE/ROCE business. So not something that excites a lot of people in general, or would excite a lot of people in general, right? Debt to equity used to be high, and interest coverage was actually a little bit stuck till this period. But then I think what happened is when they made a lot of profits here, you will suddenly see this point here is where debt to equity kind of goes down dramatically. So they were able to use the profits of that year to reduce debt. That's your interpretation. So debt repaid in 2022. That's an observation we are seeing. Let's go and check if that has happened. So if you go to the balance sheet and look at borrowings, then in 2022, yes, you see long-term borrowings go down from 15,000 to this short-term borrowing, 15,000 to 5,000, and long-term borrowings go from 19,000 to 8,000. In fact, over 2 years, 34,000 went to 8,000, right? So massive repayment of debt had happened. Some of it has come back on the books. So you'll see that short-term borrowings have gone up again. So we may want to kind of dig deeper into what has really happened there and how has that played out, right? Interest coverage was okay that year, but then subsequent years, there's again sort of, it does cover the interest, but it's not a very comfortable position to be in. So you may want to kind of look at that in a little bit more detail. Sales upon fixed assets that we are seeing seems to have spiked up again in 2022, and that's again a function of probably better realizations in 2022. So revenues may have sort of seen a quantum jump in that period while actual production remains similar, right? So if you look at this data, यहाँ पे in 2022 हम देखेंगे कि there's a massive jump in revenue, right? Whereas actual production levels would have remained same. In fact, if we go to the balance sheet, we will see that overall asset size, if you look at total equity or total assets, right, that remained 1,19,000 to 1,20,000 crore in those 2 years. So there's no real change in asset values. There's no real change in plant property and equipment. So it's not like capacity has gone up dramatically, but sales have gone up. So that gives you an indication in terms of your analysis one step further that it looks like steel prices must be the reason, not the quantity of steel that has been produced here, right? So that gives you an idea. Sales upon inventory is sort of consistent, roughly about sort of, 3 to 4 times of the inventory is what sales is. If I divide 365 by this number, I will get the data in number of days sales outstanding. So we can calculate that as well, days sales outstanding. And I can calculate receivable days, right? And inventory days. In fact, inventory is above receivable. So let's do it that way. Inventory days. And we'll copy and put it here, and payable days. And this is basically 365 by turnover ratio, respective turnover ratio, whatever is that turnover ratio that is there. So I can take 365 and divide it by inventory turnover and so on and so forth. So this will tell you approximately how many days worth of sales is needed for you to be able to recover the money that is stuck in the form of inventory, right? So हम देखेंगे roughly 3 से 4 महीने का period है. 3 से 4 महीने का sales चाहिए हमें to kind of recover the money that is stuck as inventory. 100 days के आसपास average है. Went down in 2022 because I think realizations went up, but then has gone up again, right? So this seems to be a problem point. We need to be careful about it. Receivable seems to be about that 20 to 25, 30 day period. Spiked up in 2019, 20, I think 2020. This is, I think, the point where Corona struck and global supply chains had shut down in the Feb and March of 2020. So I think receivables piled up around that time. Payable days have been historically about 35 to 40, but of late they have spiked, they've increased to 50. So it seems steel authorities delaying payments to some of its suppliers. Also sort of, the receivable cycle has gone up. If you want to look at cash conversion cycle, the formula for that is basically inventory days plus receivable days minus payable days. So approximately what is your cash conversion cycle? That data is also kind of calculated and available here, right? So we can dig deeper. The purpose of ratio analysis is once you have looked at these trends, you now dig deeper into finding out specifically what is causing this issue. Why are certain numbers going up or certain numbers going down? Is inventory piling up? If it is piling up, what is the reason for that? Is payable going up? If it is going up, what is the reason for that? The why around some of these numbers is what is real ratio analysis. What we have done so far is a quick template where we have calculated ratios. Now we are looking at observations that, okay, operating margin went up in 2020, but then came down in 2023. Why did it go up and why did it come down in these 2 years is your analysis. That is what you want to kind of master. But this sheet gives you a point about asking these questions. You can ask these questions, what happened in 2022 and what happened in 2023. Now there are various ways you can try and find this information. You can go and look at company annual reports. You can look at investor presentations. You can look at conference call transcripts to get this idea. Once this is done, this is a comparative study that you have done across this particular company and its history. You can also go and look at some of the peer companies, like let's say JSW Steel could be one. And while ideally you should be doing the same exercise for them as well, but you'll note that generally speaking, their operating margins for JSW Steel seem to be double digit all the time, right? And in the best year, it was 27%, whereas in the case of Steel Authority India, the best year was 21%, right? So seems JSW Steel is more profitable on an operating level. Why is that? Is a question that you can try and find answers to. Maybe they are selling premium steel. Maybe they are able to garner a better price. Maybe their cost measures are slightly better. So you may have to dig a little bit deeper into understanding why a particular number is looking higher or lower. That, in a nutshell, is what you would want to do. That's a broad guide for you. Please try and do this on another company. Pick up a raw Excel file, just put in data about a company from there, calculate all the ratios, and then try and note down these questions that come to your mind. क्यों कोई नंबर चेंज हो रहा है, अगर हो रहा है तो, और वो ट्रेंड को चेंज होने का जो कारण है, आप कोशिश कीजिए, try and find out if you can from some data points, from the news articles that are there, from investor presentations that are there, from earnings call transcripts that are there. Try and find that information at your end. All of these answers may not be available, but at least you should be in the position to start asking these questions. That is your first step-by-step guide for financial ratio analysis. That's it in this particular video. Do try it out. And if you want us to try this out on another company, please mention that in the comment section. Thank you.